So before we get into our next section, I just want to review the worksheet. It's the part of the book that has the transparencies in it where you lay down step by step. You don't have to go there. I just think we want to just talk about it. A couple just Q&A. Is a worksheet required? No. Is a worksheet formal or a tool? It's a tool to help build the financial statements. Okay. The trial balance and the adjusted trial balance are just like kissing cousins to each other, because then the adjustments column drives what happens over here in the adjusted trial balance. Right here, our debits will equal our credits, but is that the whole story? No, we need to adjust or talk about what was consumed, either monetary or events, and then update the trial balance. From there, you can say, all right, do you belong in the income statement or the balance sheet? The reason I'm starring all of those is it's all normal balance sides. We will do more of these. Don't feel like just what you got a week ago is all you're going to get. We will do more with this. Okay. Just remember there's this little riffraff section down here that some belongs on income statement, some belongs on balance sheet. But I technically, and I'm not going to draw a very straight line, but I'll do my best here. I technically could draw a line across, not need this, because of cash, of course, and all of through drawing is a balance sheet. Revenue and all the expenses are income statement. And then there's just maybe one or two that are kind of out of order down there. This part got kind of challenging. I saw a few of your eyes get pretty wide as we tried to figure out, but right here, these do not equal. And we need to pull them to be equal. The aha accounting moment is that we need a debit and a credit to get them to equal, and that ends up being the net income. Okay, now that was a super fast version of what we did. If this is like, whoa, I don't remember any of that, go rewatch the video. Seriously, and you'll feel pretty good about it. We will do this more, though. What's with the A, B, C, D, E's in the adjusting columns? What does that mean? Why are there letters all of a sudden? It's like 1, 2, 3, 4, 5. It's just I think it would complicate things if we'd put numbers in there, so that's why they alphabetize them. All right, let's keep rolling. I am excited to talk about closing the books. You hear of businesses are like, oh, we got to close the books before the next fiscal period starts. Closing the books means letting last year be last year and starting with a fresh start. Okay. What you need to know is that there are closing entries involved. And we close the temporary accounts and we leave open the permanent accounts. And I'll outline those right now. At the end of the accounting period, the company makes the accounts ready for the next period. Temporary accounts are closed, or in other words, zeroed out. Those involve all revenue, all expenses, and the owner's drawing. So in other words, the revenue, this was our 2017 revenue. These were our 2017 expenses, and here's what the owner took out in 2017. We close them out and zero them out. Now they funnel into basically the owner's capital account. So all of these get funneled into the owner's overall worth. Well, you guys know this. If revenue exceeds expenses, what do we have? Net income. Is that a plus to the owner's capital? It is. Is the owner's drawing offsetting the owner's capital? Yes. So it's not like we're throwing the money away that we earned. It's just that we're dumping it into the owner's overall worth. Those are zeroed out so they can start the 2018 year fresh. So you can say, here's what we made in 2018. Here's what we made back in 2017. Accounts that are permanent or not closed, all assets, all liabilities, and just the capital. We're not, if we have 25 pencils left at the end of the fiscal year, are we going to throw them away? No, they're going to roll into the next year. If we're running around with a $75,000 school bus, just because we used it in 2017, does that mean the school's going to put it free on the curb? No. Same with cash. Okay, and the liabilities are not going to just say, oh, it's a new year, you don't have to pay us. No, you still owe on all of your liabilities. But do you see how this is a snapshot of what we made in a given year? This rolls from year to year. The idea of closing accounts simply means to zero them out. So I think what you're going to do today with me is going to feel pretty easy. And closing entries are. That's actually where I want to leave PowerPoint. Not that, I mean, they have lovely stuff. Like, there's stuff there, but it's just, I like my little crash course version better. All right. So you guys had these little snapshots there, right? I'm going to write them in again. Close means to zero. We close all revenue. We close all expenses. We close drawing. Where did they go into? Into capital. Okay. We leave open all assets, liabilities, and owner's capital. So that's where all of what we closed goes into. Okay. There is an order to do this. Do you have that little order down there? Yes, you do. Do you see my 1, 2, 3, 4s? I've got them pre-labeled. The first thing we do is close sales into, we are learning a new account today, income summary. We'll label that in a minute. The second entry we do is we close, actually, you know what? I'm going to stop there. Let's do the entry first so I don't get ahead of you guys. Am I really going to have to pop back and forth? I guess I am. Okay. Sales. Let's say we are rocking a $1,000 balance in sales. You might want to have different pen colors available, and you certainly are going to want to have highlighters available. Okay. So if sales is sitting there with a $1,000 balance, and let's say this is 2017, okay? We are not going to bring that $1,000 to 2018 because this is saying in 2017 we made $1,000 in sales, okay? According to your little cheat sheet that you just wrote, what is the first closing entry that we have to do? We have to close sales into somewhere else, okay? What's another word for closing? To zero out, okay? So what I'd like you to do is make your sales T account into an I. And I want it to actually be zero, because that's what it means to close, to zero out. Okay, here's where you maybe want to switch pen colors. If you're using a pencil, use a pen. Okay, if I need to get a balance from 1,000 to 0, in this case, am I going to debit or credit for $1,000? Debit. I'm looking at the little minus and the plus sign. What would have happened if I would have credited for $1,000? Our problem would have been what? We would have had a $2,000 budget balance, and that's not true. We need a $0 balance. Okay, I have a debit. What else needs to partner with this $1,000 somewhere? Credit. Where? Look in your little notes that you wrote down. We're closing sales into what? Income summary. So I've got a debit of $1,000. We're going to put the credit in income summary. And now let's talk about income summary a minute. I want you to put revenue next to that. Income summary is a one-day account. It only exists for the closing entries. It's kind of a little holding tank, if you will, as we close all of our stuff. So it only is there for one day, and it ends up getting closed as part of the closing entries. So we just did the first one. We just did the closed sales into income summary. So we've closed the books on revenue. We've said we made $1,000 in 2017. We've now sucked that out just to put it in this income summary. Who's eventually going to get that money? The owner. Okay. Let's move on to the expenses. I don't want to have to scroll because I'm going to have to. Hang on. The second thing that I'd like you to put down here, right here, the second one, close all expenses into income summary. How many days of the fiscal year do we use the income summary? 1. When we're doing the closing entries. Now, I have 4 expenses listed here. Do you think that we have more? Yeah, I'm just going to kind of make up some silly little ones with balances. Let's say we've got the advertising expense. That's rocking a $50 balance. Why did I put that on the debit side when sales was on the credit side? Normal balance. I follow the star and the plus. We also have utility expense. That's got a $25 balance. We've got rent expense. That's got a $125 balance. And then we've got a miscellaneous expense coming into the end of 2017. That's got a $25 balance. Okay. Sometimes we have more, sometimes we have less. But we're coming in, we're like the end of the fiscal year is in front of us, and we need to zero these out. So we're going to make all of these I's. We want the balance to be 0. Let's just start with, again, change pen colors. Let's start with advertising. If I started with a $50 debit balance that now is 0, am I going to debit or credit for 50 bucks? Credit. If I had debited it, it would have been a plus, and that 50 plus 50 is not 0. 50 minus 50 is 0. How about the utility side of things? Are we debiting or crediting for $25? Crediting, because we're trying to force it to be 0. Rent expense, minus $125 on the credit side. Miscellaneous expense, minus $25 on the, oh, sorry, I had that wrong, on the credit side. The reason I have pluses and minuses and stars is just to remind you where they are on the big T. So we came in with dollar amounts sitting there. Now we forced them to be 0 by doing the opposite side. How many debits or credits do we have now? 4. Where do we close this into? Look at your notes. Income summary. So can you tell it's 200? 50 plus 125 plus 75 plus I have that wrong. I thought it was $200. No? No, it's not. It's $225. I don't know where I was coming up with all that. No, it's not. Gosh. Did I tell you $25 for utilities? Or $75? What? I was looking at it wrong. My apologies. I wrote down, and it looked like a 7. That's maybe why I said it. We had a $75 expense, utility expense. And then I said minus, oh, I want to switch pen colors, minus 25. So I'm sorry if I was saying it wrong, because I was looking at it wrong. Well, I was looking at it right. So advertising was 50, utilities was 25, rent was 125, miscellaneous was 25. Are we good? Okay, so those added up equal 1 debit. Now, could we list them all as single debits here? We could, but doesn't it make sense to just lump them together? So we're going to put 225, and that's all of the expenses. Okay. We've zeroed out sales. We've dumped its credit into income summary. We've zeroed out all the expenses. We've dumped that corresponding debit into income summary. Now, the third one, write this on your list down there. Number 3, we're going to close the income summary into capital. So we literally just use this account so we could debit it and so we could credit it. Have we made a net income or have we experienced a net loss just by looking at it? Are revenue bigger than expenses? Yes. Okay. Do that. You would pull this $1,000 down, and we want it to equal $1,000. The difference of $775, and I'll put a new pen color up here, is net income. The reason we knew it was a net income is because our revenue was larger than our expenses. In this case, 1,000 was definitely bigger than 225. Think about this a minute. This little chunk right here, did we do something like this last week? This chunk is the bottom section of the worksheet, the income statement columns. What I just got done showing you in review and what we did last week, this whole chunk right here is the income statement columns of the worksheet. Okay, pretty cool, pretty easy. I have a debit. Where's the credit have to? It's got to be a credit. Where's it going? According to what you wrote in your little notes. Capital. So we are going to put a credit of 775 down here in capital. Does that make sense? Because owner's equity is going up because that is net income. They get to keep their share of net income, right? We have one more closing entry to do. There's 4. We closed sales into income summary. We closed expenses into income summary. Remember, that's a 1-day account. We had to close that into capital. What's the last thing do you think we're going to do? Close, what's the last temporary? Close drawing into, who takes the hit if he or she takes money out of the business? We're going to close drawing into capital. I will get my numbers right this time. Let's say Mars is the owner. So Mars, comma, drawing, Mars, comma, capital. Mars was sitting there with a $100 balance. They had taken $100 out for the year, okay? To close something means we zero it. So we want it to equal 0. Are we going to debit or credit for $100 to get that to equal 0? Credit. So minus 100. I see a credit somewhere. What's the other half of the transaction have to be? A debit. To where? Capital. But bam, that means it's a hit because look at the minus. Doesn't that make sense? You will see owner's equity go down in this case because of drawing. It went up because of his share of, or my share of owner's equity. It went down because I took out $100 against the business. Are we going to close this? No, it's a part of A, L, and OE. We are not closing capital because that owner gets to take that $665 into the next 2018 fiscal year. So basically all of these entries get whittled into the capital as they move forward into the next year. You could have done all of that on this sheet, but I like to teach it this way so you can see where the numbers go. I will provide one of these on the test, but what I see by the time we get to the test, students don't even need this tool. And notice the book didn't present it this way. I did, because I think you can visually see where the numbers go. On the test, you just need to do closing entries like this. But you know what? You have all of the closing entries in front of you. We just have to put them on another piece of paper. So I would have both handy. You should have that kind of wiggly looking sheet somewhere. It's just, you can tell I took a picture of a book and it's like, it waved. I see, and I don't know if we're going to need them all, I see 1, 2, 3, 4. You just had a little cheat sheet down here of the 1, 2, 3, 4 steps, okay? We're just going to journalize them now. It's pretty easy. Our first one. We closed sales into where? Income summary. Sales was our debit. Income summary was our credit for $1,000 each. Where did I get that? I just did the T accounts visually for you, and you're just plugging them into a journal entry. Why does the second entry have so much space? All the expenses. And where did we close those into? They went into the income summary as a debit. We had the advertising expense, the utilities expense. Sorry, I screwed that up earlier. We had the rent expense, and we had the miscellaneous expense. We debited the income summary for $225. We could have debited it 4 times, but it's just cleaner this way. And then we had, was it 50, 25, 125, and 25. Those were our 3 credits. Now that was really easy because you had the T accounts and you maybe switched pen colors and you could see right away where the debits and credits were. What was the next thing we closed? We closed the income summary because the income summary only exists for 1 day. It's a holding tank while we do those other 2. Okay? Hopefully it's a net income. In this case it was. So we debited income summary. Who got to keep that money? Mars, comma, capital. And our net income was $775. If you want to make a note to yourself, this part is basically the income statement column of the worksheet. And I'll show you that again. The last entry that we do is what? We close what into what? You can look at your little cheat sheet. We close drawing. So that's the credit, Mars, comma, drawing. Who takes the hit that the owner took money out of the business? The owner. So Mars, comma, capital. And that owner took out $100. And that's closing entries, you guys. What do you think? Not bad. In the past, students are like, why don't you just show us this? Well, previous students think this is way too much work. Like, they get it. But you know what? Even if one of you needs to see it this way first, it's worth doing it this way. Moving forward, we'll probably use this again, but it's just that this, to me, is just a visual tool that helps me teach it to you, because you can see where the debits and credits are. Again, this right here. It's like getting to the bottom of the worksheet and the debits and credits don't equal, and we bring down the larger number. We force the math to equal. Now the debits and credits equal. It's just that this whole actually creates a net income. That is the bottom of the income statement, or the worksheet on the income statement column. It'd look exactly the same. Now our books are closed, okay? And we do one more trial balance. We create what's called a post-closing trial balance, because we just double check that our debits and credits equal each other one last time. Let me now bring you back to this. This is basically the same thing that we just did. I don't know if this is even in your notes. I doubt it is. Or do you have this picture in your notes? No, probably not. Okay. The only difference is it's all flopped around. Okay. Revenue, we dump into income summary. Expenses, we dump into income summary. If the expenses are less than revenue, we of course have a net income. That net income gets dumped into the capital. But then the drawing also offsets the capital. So that's just another visual way to look at it. It's one way that the book provides. Here's that little key that you just wrote down. Here's the key one more time, a little bit bigger. Remember, the word close means to zero out. This just is kind of like sitting there because of closing entries. These are all temporary accounts that we close out to start the next fiscal period. Owner's capital is, of course, one of the permanent accounts that we roll into the next fiscal period. So I'm just showing you this all again. It's just like talking about it again. Again, here's what it looks like. You can tell we left out the explanations. Is that in your notes? No? Okay. From there, we do one last trial balance. So this is number 3 of 3. We do a trial balance, we do an adjusted trial balance, and the post-closing trial balance just takes a look at, these are all the permanent accounts. What's left? What still has a balance? Let's do a post-closing trial balance, and then that's the last thing they do. Ah, I knew this was somewhere. That one's in your notes. This summarizes the full accounting period. And I want you to fill this in with me. You have now seen a full accounting period happen, okay? The first thing that happens in an accounting period is we need to analyze the transactions. Meaning, we hired someone. Have we paid them yet? Well, no. Or we paid the utility bill. Well, yeah, we did do that. So it's taking a look at what actually gets journalized and what doesn't. From there, we journalize. Remember, that's in the general journal, and it's kind of the messy, crazy thing that's in chronological order. Okay. What happens next after we journalize? It's all the little mini, remember, we post to the general ledger. From there, we make the first trial balance. As you learned in the last one, then you journalize and post, I hope it says and post, yep, the adjusting entries. We journalize and post our adjusting entries, so all the deferrals and all the accruals. Okay, then what do? We make another one of these, only it's the adjusted trial balance. Because although our debits are going to equal our credits, you can tell that, holy moly, there's a lot more steps that need to happen. So although our debits and credits probably equal here, look at how much of the story is left to tell. So then we adjust, like we did in last chapter. We make an adjusted trial balance. From there, we make financial statements. In a certain order. The income statement rolls into the owner's equity statement that rolls into the balance sheet. What you just learned about, you journalize and post the closing entries. And remember, we close or zero out all temporary accounts. And we make our third trial balance. This one's called the post-closing trial balance. So we stop and make sure our debits equal our credits 3 times. This is the final say, though, the final story of the fiscal year. And then as we literally close the books on one year and open them the next year, those are the beginning balances that roll into the next fiscal period. I'm going to read to you what the book says. Well, I wanted to do this too. This is nice. These 3 steps happen daily. These 4 steps occur periodically, or every time financial statements are made. Now, if that's only once a year, then they're going to only happen once a year. Maybe it's quarterly, maybe it's monthly, okay? And then these happen every year at the end of the period. As the book says, there are Also, 2 optional steps in the accounting cycle. You can do a worksheet. That's what we're going to do now. Well, we did it once, and we'll do it again. In addition, they may use reversing entries as explained below. So reversing and correcting entries are something that you're going to learn about not tomorrow, but Wednesday. And they're not necessarily in this conglomeration or mix.